You think a legacy business exists to sell products, but at the nine-figure level, a beloved brand is just a host organism waiting to be stripped of its underlying real estate. It is a vehicle allowing you to extract a $1.5 billion cash payout while the operating company chokes to death on the very leases you just created. This is the amateur belief that a corporate bankruptcy means the owners lost money. In reality, the architects engineered the insolvency a decade in advance. They extracted their principal and profits through real estate arbitrage, leaving a hollowed-out shell to take the fall. You are stuck in the builder trap. You sit in your room perfecting software, tweaking supply chains, obsessed with making a product 5% better. You think the market rewards the best operator. It does not. The market rewards the one who controls the structure. Today, you will master the OpCo/PropCo sale-leaseback extraction model. You will learn how to sever the hard assets from the operating business. You will monetize the real estate to immediately recoup your equity, what you actually own after all debts are paid, the cash value in your pocket, like the paid-off portion of a house. And you will transfer all downside risk to the unsecured creditors. Let the suppliers and the landlords fight over the scraps in bankruptcy court. Step 1. Identify a legacy, cash-flowing business with a massive, unencumbered real estate portfolio carried at historical cost on the balance sheet. You are looking for assets, things you own that put money in your pocket or grow in value, a house you rent out, shares in a company, a small business. But you want these assets unencumbered, meaning they have no debt attached to them. They are sitting there, free and clear, hiding inside a boring company. You buy the company using primarily debt, securing the loan against the very assets you are about to strip. This is an LBO, a leveraged buyout, where you buy a company using mostly borrowed money. You use leverage using borrowed money to multiply your potential returns, like putting 10% down to control $1 million property. In 2014, Darden Restaurants had a problem. They owned Red Lobster, and they were bleeding cash on declining shrimp sales and operational headaches. The amateur operators at Darden looked at Red Lobster and saw a failing restaurant chain. They saw angry customers and rotting seafood. But Golden Gate Capital, a private equity firm, looked at the exact same balance sheet and saw something entirely different. They didn't see a restaurant. They saw roughly 500 prime real estate parcels sitting debt-free on the books. Golden Gate bought Red Lobster for $2.1 billion, and they didn't use their own money for the bulk of it. They used the real estate as collateral, the asset the lender can seize if you do not repay. You think you don't have the capital to buy a business. You ignore the fact that the business itself buys the business if you know how to structure the paper. Step 2. Execute the OpCo/PropCo split. You sever the operating company, the OpCo, from the property company, the PropCo. You sell the real estate to a real estate investment trust, a company that owns and leases out income-producing properties. In exchange, you force the operating company to sign 15 to 20-year triple net leases. This is the kill shot. A triple net lease, a contract where the tenant pays rent plus all taxes, insurance, and maintenance. The landlord does absolutely nothing but collect the check. You set these leases at aggressive cap rates. A cap rate, the capitalization rate, the annual return on a real estate investment based on its cash income. You take the cash from the real estate sale to immediately pay down your acquisition debt. Then, you issue yourself a special dividend. A special dividend, a one-time cash payment to shareholders, usually funded by selling off a massive asset. Within weeks of the 2014 acquisition, Golden Gate sold Red Lobster's real estate to American Realty Capital Properties for $1.5 billion. Watch the machine work. They immediately recouped 71% of their entire purchase price in cash. The risk was gone before the ink was dry. They shifted the entire burden to the restaurant chain. Red Lobster now had an artificial, massive rent expense that hadn't existed a month prior. This destroys the company's EBITDA earnings before interest, taxes, depreciation, and amortization, a company's cash profit from its core operations before accounting tricks. You are a builder, you think rent is just a cost of doing business. You don't realize that in this game, Rent is a weapon used to extract the soul of the company. Step 3. The operating company is now a ticking time bomb. The newly manufactured lease liabilities destroy operating margins. Margin the gap between what it costs to run the business and what it actually brings in. When macroeconomic pressure hits inflation, labor costs, or a bad shrimp promotion, the OpCo defaults and files for Chapter 11. But because you already extracted your equity through the sale-leaseback and subsequent dividends, your downside is zero. Golden Gate sold their remaining equity to Thai Union in 2016, completely exiting with a massive multiple. And then the inevitable happened. In May 2024, Red Lobster filed for Chapter 11 bankruptcy. They cited $294 million in crushing lease obligations. The media called it a tragedy. They blamed the failure on an endless shrimp promotion. Imagine believing a multi-billion-dollar deal collapsed because people ate too much seafood. I call it a flawlessly executed heist where the getaway car was a legally binding commercial lease. As we sit here today in 2026, analyzing the fallout, the autopsy is crystal clear. The private equity sponsors won the equity game. The unsecured creditors, the employees, and the final bag holders took the loss. You cannot execute this maneuver if you suffer from the disease of the builder, emotional attachment. This requires absolute emotional detachment. You cannot fall in love with the brand, the legacy, or the employees. You must view the business strictly as a balance sheet of separable assets. It is not a family, it is a math equation. Self-protection demands ironclad entity architecture. The OpCo and your holding company must be walled off with non-recourse structures. Non-recourse a loan where the lender can only take the specific collateral, not your personal assets or the assets of your parent company. When the OpCo inevitably defaults on its engineered leases, aggressive creditors in the 2024 through 2026 bankruptcy courts will come looking for blood. They will try to pierce the corporate veil, the legal wall that stops a company's debts from becoming your personal debts. They want to claw back your historical special dividends. They want the $1.5 billion you extracted 10 years ago. If you built the architecture correctly, they will fail. The law protects the structure, not the sentiment. You spend your 20s trying to build a better app, thinking the guy with the cleanest code wins. The guy who owns the server farm your app runs on just bought his third boat. He doesn't care about your user interface. He cares about his cost basis, the original price he paid for the asset for tax purposes. He understands cash flow, the actual cash moving in and out of a business, like the money left over after paying all your monthly bills. You build systems to serve users. Apex predators build systems to extract capital. They don't negotiate with the product managers, they negotiate with the debt markets. If you want to cross the chasm from being a disposable operator to being the capital that owns the board, you must learn to see the matrix of leases, debt, and collateral. Stop looking at the restaurant, look at the dirt underneath it. Here is your assignment. You will not watch another video until this is done. Identify one local legacy business in your town, manufacturing, retail, or logistics, a company that has operated for 20+ years and owns its real estate outright. Pull the county property records, calculate the current market value of the land and the buildings. Model a theoretical OpCo/PropCo split. Create a scenario where a sale-leaseback at an 8% cap rate covers at least 75% of the business's acquisition cost. You will complete this single-page model by 5:00 p.m. Friday. And I already hear your excuse. I don't have the capital to buy a real estate-heavy business. You are completely ignoring that the real estate itself is the collateral that funds the acquisition. You don't bring the money, you bring the structure. Amateurs bleed for decades trying to grow top-line sales. Apex predators strip the balance sheet, pocket the equity, and let the carcass pay the bill. Build the model, protect the holding company, master the code.